Hello, this is Stephen Peake with an update on Henderson European Focus. Well, quite a bit's been happening, I think, on the European scene in the last few weeks. We had the European parliamentary elections, which I think, just to basically take a summary view, there was quite a big protest vote across most countries, and I think that reflects clearly, disquiet, unhappiness. Nobody likes austerity or low growth or difficult employment conditions. And clearly, one of the things that can happen in elections, you get some sort of protest vote. And I think that's clearly what we very much saw. The issue is really more interestingly where it goes from here. We're currently just about to appoint, or the EU is just about to appoint a new president. And be interesting to see whether there's any perhaps change in tone in terms of the EU looking at itself and thinking perhaps we can do better, we can be more accountable, and that remains very much an open question. Cynics would say don't raise your hopes too high, but clearly we'll monitor that, particularly as it affects the investment world over the next few months or so. More recently, we've had the ECB come out and propose new measures, I guess, to help promote and stimulate growth across the Eurozone. Remember, of course, that the Eurozone, which clearly is not all of Europe, the countries that are subscribed to the euro currency, there's quite a mixed picture. Northern Europe, obviously Germany being the best example of that, broadly okay. The issues remain very much in the south, where I think the word anemic is often used and is pretty accurate to describe the state of recovery we're seeing there. The ECB is also very concerned, and has been consistently concerned, about deflation. We do have inflation in the Eurozone, but it's not very much. And so they've always been very, very anxious to avoid the pitfalls that Japan went through. And clearly, once again, for Mr. Draghi, he has signalled very clearly that the ECB will continue to take action, and more action if necessary, to stimulate recovery or firmer grounding or foundation building in recovery, and obviously encouraging the whole plumbing of the economies to work, bank lending, etc. And I think, to some extent, I feel relaxed about that, because clearly, even if we do hit another dull patch or we fail to ignite from here, you do feel there will be a reaction from the ECB. So I think, again, something to watch for us and something to monitor. But at this stage, I remain very much recovery-minded, in the sense that I do think we are seeing progressive recovery. Not strong as clearly any of us would like, but I think the individual economic data points coming out, there are still signs of recovery or bottoming out from market to market and sector to sector. And so I think we're at the moment, we still feel okay that we are in a recovery mindset in terms of the overall macro. Outside of the Eurozone, clearly there's a much clearer picture. I'm speaking to you today from London, which unusually for us over the decades, we are probably the best performing economy in the developed world. GDP expectations for the UK this year are probably above 3. If you go back maybe 12 months or so, the best number you could probably come up with from economists for 2014 was probably something in the mid-ones. So clearly things are getting broadly better here in terms of the big numbers. There's much more of a finer debate about, if you like, the standard of living in terms of across the UK, but that is more of a local issue rather than something that affects the euro scene overall. In terms of companies, well, I think we have had a re-rating. Multiples have expanded, and there is an argument that bears would say that earnings haven't really come through as much as we would have envisaged to really justify that re-rating. I think there's some truth in this, but I think Europe never tends to run straight and true. There's always bumps along the road, and I do think that when the next sort of important point for certainly my focus is clearly we're now approaching the end of the month, the end of the quarter, the end of the half year. And the next thing from corporates will be a succession of quarterly releases, results, but obviously just as important, if not more so at this point, is really the outlook statement, how they are seeing their business develop, what actions have they taken to respond. And so the, if you like, the nitty-gritty fine detail will be quite interesting to observe. Overall, my view is still constructive. I still think there are still opportunities within individual equities. The stock picking style, I think, works very well. And so from that perspective, I think I'm comfortable. The issues in the portfolio are somewhat different, and I'll come on to those now. I think the nature of the portfolio is still broadly intact in the sense that we still have the same three disciplines, very much a bottom-up fund, very much blend style, irrespective of growth or value, and clearly the ability to be across the capitalizations over the different cycles. I think there's been a slightly, whilst the structure of the portfolio hasn't changed too drastically for many metrics, there's been a bit of a shift. I think I've moved away a little bit from some of the raw recovery stocks, not because I don't believe in recovery anymore, but I think some of the valuations of some of those stocks is actually now pretty reflective of recovery coming through. In fact, a few seconds ago I talked about being agnostic between value and growth. I think there are some situations in Europe which are more of the growth variety, which I think are a little bit underpriced. And clearly the old mantra still holds true in a world of relatively low growth. Surely growth is scarcer and therefore should be more valuable. So I think there's a few angles within the portfolio which I'm looking to get a little bit more growth exposure when I can find the right candidate. In terms of the other things to talk about the fund, probably the capitalization structure of the fund has probably gently moved upwards. In other words, we've probably got a little bit less now in small cap than we did, a little bit more in mid certainly, and to a lesser extent large. And I think to some extent small cap around the world, and Europe in particular, has broadly done pretty well. And as a result of that, good opportunities a little bit more difficult to find. So I think there's been a natural, if you like, moving away a little bit from small cap across the portfolio. Other things to mention on the fund, I suppose, and clearly what we all care about very much is performance. This year it's been quite notable, not just in the European category, but most categories. It's been difficult to keep up with the market. The index or the ETF has been generally higher up the performance ranks than in the past. Now, clearly this happens from time to time. I mean, no active fund manager does well every day, every week, every quarter, but clearly we all try to develop a long-term track record, which European Focus certainly has. So whilst we're a little bit behind the index this year, certainly 5 months in, that doesn't really concern me too much. I mean, I'm much more concerned in these circumstances that we rank competitively versus our peers, and we certainly do. You can cut and slice the figures yourself to check that out. So I think we've navigated through this year pretty well so far. And I think, clearly, I think there was a possibility of making some more gains before year end. The other thing in the portfolio which is worthwhile mentioning, I think, for those of you who I've been in conversation with for a few years, you'll know that I tend to be very keen in terms of looking at IPOs, new market introductions. That can occasionally be a source of performance. This year, until very recently, it's been notable in that I've done 0 IPOs. I haven't bought a single one. Reason being that obviously with the slightly more a better tone to markets, rising markets, buyers have been, I think, less picky, and clearly my ability to effectively drive the price, or my pricing power, if you will, has really depleted somewhat. And so as a consequence, deals are coming, I think, fairly fully priced, or recognising in some cases good companies, but if the share price recognise the prospects in those companies, clearly that's not particularly attractive equity to invest in. That's starting to shift at the margin a little bit. And I think one of the reasons is you may have read that the performance of IPOs this year, certainly in Europe, has been poor. You've generally lost money rather than made money. And I suppose, like all these things, there's a response. And I think we're seeing a bit more realism coming through. And I've just bought my first IPO for calendar 2014. Unfortunately, I can't give you the name for disclosure reasons, but you'll see that in the coming months when the portfolio is made public. So maybe that's the start of a trend, maybe not, we'll see. But certainly it's one of the features of the market that I think is quite interesting this year. So overall, I think we're in decent shape. Europe is never ever straightforward, as I think you all know. We tend to occasionally go 2 steps forward and 1 step back, but I think that is a net positive, and I think that's where we'll continue to progress through the year. The other factor I should mention earlier, just as an update, is currency. We've been of the view that the dollar is a little bit too cheap, and probably surprised by that the euro, in fact, was the strongest currency last year. We've had a hedging or a partial hedge in place on the portfolio. We maintain that hedge, which is a very simple, long dollar, short euro position, and that roughly accounts for about 18%, high teens percentage of the fund's NAV. So if we're right, and the dollar having a little bit of strength, clearly we will offset a degree of that as a result of the hedging position. So that's it on European Focus. Thank you for your attention. We look forward to the rest of the year. Thank you.